Good
Morning,
morning,
Rick.
Beth. You okay?
Good, thank you. Yeah, very good.
Good, good. Nice to have you on this morning. Um, so there's your sort of bio there. But what I think like we normally do, we'll hand it over to you to talk through your slides for sort of 5, 10 minutes, and we'll open up to Q&A. So
Great. Yeah, fantastic. But what we do this morning is just take a quick tour through the UK grocery sector in general, the impact of online on UK grocery, and then how that flows into supermarket property. So yeah, on this slide, just as a very quick overview, these are the main players in UK grocery. You can see Tesco still has a very large market share. I think what's been notable over the last decade is the growth of the discounters, Aldi and Lidl. So Aldi's actually now bigger than Morrison's on a market share basis. It's also interesting, I guess, to look at that bottom line where we see online market share. Tesco's really is dominant in online, and you'll see why in a minute as we go through. And obviously, the discounters don't play in that space at all. So if we flip over to the next slide, yeah, just I talked about the impressive growth of the discounters over the last decade or so. We think that's going to slow down now. That's for a couple of reasons. So this slide is just showing you the level of price inflation that there's been in the market over the last almost 18 months. And just focusing on the discounters, Aldi and Lidl and Sainsbury's and Tesco's. And so I guess what you can see here is that Sainsbury's and Tesco have found more ways to cut costs and not pass through the full impact of food inflation, whereas Aldi and Lidl at times were passing through 25% year-on-year increases in price. And so that kind of that gap between the lines is effectively the erosion of the price advantage that Aldi and Lidl have over the others. So they are still cheaper, we think, but they offer a limited range. They don't allow customers to shop in all the ways that they want to. And that's a major advantage for the incumbents like Tesco's and Sainsbury's. There's also a big shortage of space out there for new stores, and that's really been Aldi and Lidl's strategy. So they're very impressive operators. We just think their rate of growth is going to slow down quite a lot from here. So we flip over again. Just focusing on growth, I think people quite often miss the fact that UK grocery has actually been a very strong underlying growth sector from a revenues point of view. So in 2017, when we launched Supermarket Income REIT, we would never have dreamt that there would be 30% growth in supermarket revenues, grocery revenues over this period. There've been two big impacts really. So the first one was COVID, which created a big step up in grocery volumes. And that's only partially receded because people have continued to work from home, and that just drives people to buy more of their calories from supermarkets. So they don't go to Pret as often as they used to. They when they're working from home, they buy the ingredients for lunch from the supermarket. And then obviously the recent bout of very high inflation has also increased grocery sales dramatically. So we flip over again. Looking at, I talked about allowing customers to shop in the way they want to, and that's a key part of the way we look at grocery. So I'll talk a lot about Omnichannel. I just wanted to touch on what an Omnichannel supermarket is. So it's a traditional store with a big car park and lots of room to move trucks around. But what you find is that there are people who shop in store, so a traditional method of shopping with a basket or a trolley. But they can also click and collect at the store. And there are vans leaving all day delivering home deliveries of groceries to the local neighborhood. And those groceries are picked from the store. So the store effectively acts as not only a traditional shop, but also a last mile warehouse for grocery. So turning over again, just looking then at kind of how that market growth is split out and focusing in on omnichannel supermarkets on the left-hand side. So the two fastest growing segments of grocery have been the discounters, that's the light blue one, 15 billion of growth, and omnichannel supermarkets, which is the dark green one, 16 billion. I think what's really interesting is that the discounters have had to open 525 new stores in order to achieve that growth, whereas the existing operators have only opened one new store over the period to achieve the growth in omnichannel supermarkets. So one of the things we think is going to happen going forwards is there'll be an intensification of the use of this space that already exists, because the grocery market is going to continue to grow with population growth. But actually, there are very few suitable sites left for these stores. So the trading on these sites is going to become more intense, and that's a great opportunity as a landlord. So we flip over again. So yeah, what we love about the omnichannel sector is that it kind of combines two of the quickest growing parts of grocery. So you've got supermarkets and you've also got online. And actually, what a lot of people don't realize is that 80% of online grocery in the UK is fulfilled from a supermarket. That really surprises most people. We'll go on in a second to look at why that is from an economic point of view, why it makes so much sense for the operators. So flip over here. So the chart on the left, or the map on the left, shows you the network of Tesco stores in the UK, which fulfill online. So the blue dots are stores which also deliver groceries to the local neighbourhood, and the red dots are ones which aren't a store. They're just a central fulfilment centre, so using a shed to deliver rather than the existing store. I think what's really striking is that all of the central fulfilment centres are clustered around London, and that's because there isn't enough supermarket space per head to actually be able to deal with the volume of groceries that need to be delivered. Now, everywhere else in the country, Tesco uses the existing store, because that store was originally built to have the perfect catchment area for a sort of 15-20 minute drive time for customers to drive to the store to do their shopping. And funnily enough, that works brilliantly the other way around. When you're doing home deliveries, you pick the groceries in the store and then you drive them out to customers who are very close to the store. Now, the bars on the right kind of illustrate the cost impact of that. So if you use a central fulfillment center, you just by definition have to drive much further to your customers. So the numbers on the left are actually Ocado's numbers from their annual report, and we've backed out that it costs them about £13 per delivery to make an online delivery to a customer. The numbers on the right, the £7 are Tesco's and Sainsbury's numbers, and this is driven almost entirely by the fact that Ocado has never achieved 2 drops an hour, whereas Tesco's and Sainsbury's tend to get between 4 and 6 drops an hour. And of course, it costs exactly the same for Ocado to have a van and a person as it does for Tesco's. So if you can use that van and a person for at least twice as efficiently, it massively reduces your delivery costs. And it also turns out that picking from store is actually really quite efficient too. So you can see the pick and pack cost is not materially different. And so this is why the big supermarket chains have chosen to almost exclusively use stores as their distribution model. It's called the store pick model from omnichannel stores. So moving on to the next slide. So that kind of brings us into how does this relate to real estate as an investment? So what we really like about grocery real estate is that fundamentally it's benefiting from non-discretionary consumer spending. Effectively this is food infrastructure, and that's really been sort of proven out over the last few years. From a cash flow point of view, they tend to come with long leases with inflation-linked income, so you get a very strong tenant in a Tesco's or a Sainsbury's, and you get a very predictable income stream with contracted rental uplifts. The real estate is mission critical to the operators. They just can't move these kinds of stores. So these stores tend to be around 10 acres of site, and with a 80,000, 100,000 square foot store and a petrol station, and it's just impossible to find substitute sites for these. So it's really difficult for them to move. And what that means is they tend to invest very heavily in the store. So if you're the landlord of one of these stores, it's quite an unusual situation that your tenant will actually spend millions of pounds on your asset because it's a critical trading asset for them. It's very unlike other sectors in real estate, like office, for example, where the landlord doesn't benefit from tenant expenditure. We like the stores that are future-proofed. I've talked about Omnichannel already. Clearly some sectors of retail have been highly challenged by the advent of online. Actually, supermarkets have proven to be central to online for the supermarket operators, and so we think they're future-proofed. And that lack of available sites, which I mentioned at the beginning, we think provides a really strong tailwind for market rental growth going forwards. Turning over the page, I think we're looking at investment volumes. So again, it's the actual market in supermarkets is pretty liquid. Relatively consistent investment volumes, even in a very difficult year like this year, where to June we've seen 1.7 billion of transactions. I think one thing that's really unusual, again, in supermarket property, which again makes it a really attractive space, is that the operators actually have been buying back a lot of their stores. So Tesco's and Sainsbury's are generating a lot of free cash flow. They have very strong balance sheets. They used to do a lot of sale and leasebacks, and actually they've kind of changed their minds on that strategy now, and they're looking at buying back freeholds. So you can see that Tesco's has been a very significant purchaser in the market over time. It's one of the things we really focus very hard on, is having very close relationships with them to understand how we can both operate together in the market. But in the long run, we think this is very positive for values. And over the page again, this chart just shows you a historical yield series. So the colours aren't very different, but the green line is logistics. So this is the net initial yield on logistics from the MSCI index, and you can see logistics used to be very cheap back around the GFC, and actually now it's very expensive. UK all property is a kind of similar story. That's still at around 4.9% net initial yield, whereas actually supermarkets have drifted out quite a long way. They used to be one of the most expensive asset classes, and now they're one of the cheapest. So we think actually now is a great time to be investing in supermarket property, because actually that pricing doesn't really reflect the fundamentals of the sector. And then over the page, I just wanted to summarize why we like supermarket property so much. So it's that long inflation-linked income, future-proof stores. So these are stores which benefit from the growth in online in the future, and we have very significant asset backing. This is acres of sites which are located adjacent to very large population areas and also to arterial roads, so you have great access to the site, so you can move an awful lot of customers and also online deliveries in and out. So I think that's the end of the slides for the presentation, but obviously be happy to take questions.
Great. Yeah, questions have been flooding in, so we'll crack on. I think I sort of throw in the first one. We've got a question here from Keith asking, can the business continue to grow without new capital? Are you able to recycle capital to increase the NAV and the divvy?
Yeah, so the short answer is yes. We're very actively looking at that. I think one of the big skill sets we have actually is in the re-gearing on the leases, and so we think there's a big opportunity to re-gear leases back into longer leases which trade on lower net initial yields, and so that's something we're looking at really actively, and then that would enable us to recycle some capital.
Cool. Now I'll just take the slides back a bit. Yeah, this one. So a couple of questions on the Sainsbury's and Tesco's sort of coming back in and buying back. So first of all, let's establish what percentage of the supermarkets are already owned by Tesco and Sainsbury's rather than leased?
That's a good question. I think Tesco's is about, maybe it might be about 60% freehold now, 40% leased, and Sainsbury's is probably around the same.
Okay.
So there's a very significant number of leased stores still out there. So the leased store universe is about 35, 40 billion stores.
Okay. And with those sort of coming back into the market, you obviously say it helps with values and stuff like that. Does it not take away opportunities for you guys as well? And also, have they approached you to buy back some of their stores from you guys?
Yeah. So yeah, I mean, we do tend to be looking at buying the same stores, and so actually we had a big JV with Sainsbury's, which actually bought back from us earlier on in the year. So, but usually for ones that come up in the market, you know, there's enough good property out there for us to kind of for us to play and for them to play as well. Yeah. They tend to have a kind of a limited budget every year to spend on buying back stores, so that's going to work pretty well so far. Yeah, and I think, you know, ultimately, you know, it might be that we do sell a big block of stores back to Tesco's and Sainsbury's from Super and return cash to shareholders. That's definitely, you know, something that we kind of evaluate on a sort of running basis, whether that's an attractive thing to do.
That'd be interesting. Yeah. Cool. A few questions here on acquisitions. So first of all, can you elaborate on your acquisition process, and then sort of we'll talk a bit more about the market and stuff.
Yeah. So I mean, I think starting from how we kind of originate opportunities, we because we are the sector specialists, we basically know kind of where all of the leased or where all the acquisition opportunities are. So we know who owns them, how long they've held them for, what they got them valued at, and so we tend to know kind of before the market does, you know, when somebody's interested in selling a store. So we get a first look. We can do an off-market transactions, and those are the best kinds of transactions, to be honest. You don't really want to be in a bidding process. We also have a really good insight with the operators. So when we're looking at buying a store, clearly we'll do our own due diligence. So we'll go and do site visits, meet with the store manager, you know, evaluate trading and so on. But we'll also have a channel into the Tesco's and Sainsbury's to actually get their view on the store trading, make sure that you know that it corroborates our view. So we're always buying stores that are Q1 or Q2 traders for them. Yeah, and then if we then proceed, then we've got a very you know, rigorous due diligence process, as you'd expect for property acquisitions.
Yeah. Okay, cool. And are you seeing many opportunities in the market at the moment? Are there distressed sellers and things like that?
There are some interesting opportunities. I think as Keith highlighted earlier on, we don't really have the capital to take advantage at the moment, but we're working on that. So yeah, there are some interesting things out there, which if we had capital, we would be interested in bidding on.
Cool. Okay. What should we go next? So what is the current split of the portfolio, as in tenant wise? So it's mainly focused on Sainsbury's and Tesco, isn't it?
Yeah.
Do you have any sort of Morrisons and Asda or any of the others?
Yeah, so we've got a little bit of so Tesco's is nearly 50%, Sainsbury's is about 30%, Morrisons is 6%, and Asda's 2%. We've got a bit of Waitrose, a few Aldi's, and a couple of M&S's. So yeah, we've always kind of focused on Tesco. Well, Tesco's and Sainsbury's had historically, leased more stores, so there were just more available to buy. We, you know, that meant that we've been kind of weighted towards them. They've also had, you know, very strong balance sheets, and they're listed companies, so we much prefer them as tenants. You know, we've got a relatively small exposure to Morrison's and Asda. We're very comfortable with the stores there because they're very strong trading stores. So if something happened to Morrison's or Asda, because they are quite highly levered, we're really confident that we could relet those stores to somebody else. That's kind of the thinking on those ones.
Yeah, no, that's interesting. Yeah, and do you obviously you said you've got a couple of Aldis in there. Is that do you see that side of things growing with the sort of discounted?
Yeah, it's tricky with them actually because they're very small lot sizes, and they're not as, from a sort of real estate point of view, they're not as sticky as the big sites because they're much smaller stores and don't have as much car parking. It is actually easier for Aldi and Lidl to move, you know, within that any given geography, and we've quite often seen that where they've exercised a break in the lease and then just actually left and developed a new store up the road. So it's not a strategy to focus on growing those. We tend to pick them up when they come with something else. So, for example, in Leicester, we next to our Tesco's, there's an Aldi kind of on the parade, which came as part of the transaction. That works really well because that's just not going to move anywhere because of the Tesco's. But yeah, I don't think we'll ever become a major landlord of theirs.
Yeah, cool. That makes sense. We've got a couple of questions on the other Atrato trust.
Oh yeah.
So Roof. So what is the relationship with those guys? And also we've got a question here on solar on the roofs as well. So that might feed into that.
Yes, I mean, I guess the roof fund kind of its genesis was that we were trying to put panels on the roofs of the supermarkets, and basically we concluded that we needed to hire a specialist team to do that. And then when we found our specialist team, they had a pipeline of other stuff which wasn't supermarkets. So then that triggered the thought to raise a separate fund and have a separate strategy. So the roof fund is completely independent of Super, so it's got an independent board of directors. The fund management team's completely separate. But we have a relationship between the two funds where Roof is installing panels on the roofs of Super's stores. And that's an attractive business for Roof because that team has all of the I mean it's a very fiddly process, mostly around documentation to get the lease of the roof and sort out the power purchase agreement with the tenant and so on. It's taken us like 4 years to reach a framework agreement with Tesco's. So it makes sense for Roof to do that because they've got all of the expertise, and so that's what we're doing. We just completed our first one on Tesco in Thetford, and then Roof actually owns panels on the roofs of about 20 or 30 Tesco stores, which aren't in the Supermarket Income REIT portfolio. So again, it makes sense for Roof to have the solar relationship with Tesco's because they can put it on Tesco freeholds, roofs of other landlords, and obviously Super couldn't do that.
Yeah. So with the income that comes from that, then that's going to Roof, and that's not going to Supermarket. Is that right?
Yeah, so it's Roof's capital that gets put into the project, and then the income on the power purchase agreement goes to Roof. I mean, interestingly, Super gets a kind of benefit because you typically get a one-notch upgrade in your EPC for having solar panels on the roof. So Super effectively gets a kind of a free environmental upgrade to the building, which is quite attractive. And obviously that's becoming kind of more and more important as the valuers start to take that into account in terms of their appraisal of the property. So it's very positive for Super from that point of view.
And you said you now got a framework in place with Tesco's. Has it been difficult having conversations with your tenants about putting solar on the roofs and whether they want it and how they would.
Yeah, it's just the factor of dealing with very large organisations and their sort of procurement. So I think the goal with Super is that we'll have solar on the roofs of everything. Ultimately, it does going to take quite a long time because there's a question of it's mostly a question of whether the tenant is willing to sign a long-term power purchase agreement for that site based on the economics of that site. But I think the cost of panels is going to keep coming down. It's going to keep getting more and more attractive, and it's very hard for them to hit their net zero commitments without doing it. So ultimately, I think we'll end up with panels on the roofs of everything.
Yeah.
Great outcome, and possibly carport as well. That's the other thing that could happen going forwards is that you put carport solar in the parking.
Yeah, no, I agree with that. Yeah. Let's talk about the investment market. I think we had a slide here. Yeah, this one.
Yeah.
With the yields obviously shot up with interest rates. Now that it seems that interest rates have peaked.
Yeah.
Where do you see that going from here?
Yeah, I mean, it seems quite irrational to us. I mean, when you look at, Super's portfolio is valued, I think, average yield 5.6, because obviously we own more of the higher quality kit and it tends to be longer leased. But we think that with the leverage in the fund, we think that generates kind of somewhere between a 10 and a 12% return long term.
Wow.
That seems really attractive from the point of view of you've got very strong tenants, you've got basically food infrastructure, and you've got contracted leases for a long time, and to be able to earn those kinds of returns seems extremely attractive. So I think that as people get more confidence that we've reached the top of the interest rate cycle, then I think capital is going to flow back into this sector.
Yeah, because what kind of discount are you on at the moment to your NAV?
10% ish. Yeah. Yeah. NAV's 93, I think, and we're 83 ish.
Yeah. Yeah, it definitely seems like an opportunity. So yeah, that would be good going forward. So where should we go next? Your gearing levels. What is your sort of debt levels? What are the interest rates you're paying on them? Are they fixed, floating?
Yeah, so we are just going to make sure I've got the right number in front of me. We're kind of 34% LTV, kind of right in the mid 30s LTV, and yeah, cost of debt is just over 3%. So that's fixed for nearly the next 3 years.
Okay.
So yeah, we've got a very strong banking group, they're very supportive. We've just added another one, which was Sumitomo Mitsui Banking Corporation. Yeah, and the strategy is to just keep extending the hedging that we've got in place. So we feel pretty comfortable. If you look at the shape of the interest rate curve, then we've sort of hedged through the real sort of hump at the front end. The market's expecting rates to be significantly lower in 4 or 5 years' time.
Yeah. Cool. Got a question here on. Okay, yeah. Sorry, no one just popped in on debt, so we must take that. So have you utilised the new credit facility, and has this had a positive impact on earnings over the past year?
So we SMBC came in as a refinancing of some of the other facilities. So we have some debt headroom. So we typically have about 100 million of debt headroom. But I think we don't really want to increase leverage right now, because we're at 34 LTV at the moment. I think the market, and we would like to have a little bit of clear air between us and 40, which I think is where, is the absolute maximum we want to be at. And I think the earnings impact has really been, we're effectively sort of fully deployed. Unfortunately, the kind of increase in interest rates has sort of offset the positive impact on earnings from deploying into more assets. So, we're very confident about having a covered dividend, for the foreseeable future. And I think that, the most effective way for us to increase earnings is to go back to that point about recycling capital, which would be kind of selling lower yielding assets and buying some assets which present value opportunities.
Yeah, that's interesting. Cool. One question here on diversifying the portfolio, and would you look to buy abroad?
I think long term, I think expanding into Europe would make a lot of sense. Clearly, that would require us to raise capital. So, we're not really in that environment right now. But if we get back to the environment where we are able to raise more capital, then there are definitely attractions in using our expertise to diversify into Europe. And we do have really strong relationships with some of the biggest operators in Europe. So we've really got that side of the equation.
Yeah, no, that'd be interesting. Just need it all to come back really. So with sort of the online, you obviously talked about that quite a lot in the presentation. So what percentage is that at the moment of all grocery retail?
I think the latest is about 12. I think it got up to about 15, slightly higher during COVID. It's kind of drifted back.
Yeah. So what was it pre-COVID?
It seems about 8 pre-COVID.
Okay.
So it kind of doubled through COVID. And I think, it's interesting because a lot of the people we speak to on a day-to-day basis are kind of based, inside the M25. And have quite a sort of warped view of the world.
Yeah.
And actually don't realise that when you go outside, London, then a lot of the country, are in their cars like every day, right? So if you're one of the reasons why home delivery spiked so significantly, I mean, it wasn't just because people didn't want to make contact with people. It was also that people were at home all the time. And so actually then it's really convenient to get home delivery because you can get it any time of the day.
Yeah.
If you've got a job which means you're out of the house, whether that's going to an office or working in a hospital or whatever, actually it's quite often more convenient to go and do a click and collect than it is to have a home delivery. And obviously it's really hard to find delivery slots when everyone wants the delivery between 7 and 9 in the evening. So actually the fastest growing part of online in the last few years has been click and collect for that reason.
No, personal experience of that as well. We started doing click and collect as well. So if that continues to, do you see that continuing to sort of steadily rise over the next sort of medium term?
I think so, yeah. And you may have noticed that the supermarkets have been investing in click and collect to make it a kind of easier experience for customers. So the best ones, like we've got one in Newmarket, and it's got number plate recognition, so that as you drive up, they know you're coming and your stuff's just ready as you want, right? And those kinds of things just make it super easy for customers to use. It's also cheaper, right, as well, because I mean, on average, unless you have a sort of delivery saver option or something, you're paying sort of £5 or £6 for a home delivery, and they usually charge £1 or £2 for click and collect, but they're not having to incur the cost of that driving piece. So supermarkets are definitely encouraging click and collect over home delivery.
Yeah, no, definitely. And coming back to your cost slide that you had there, now is all of that passed on to the customer?
No, no.
No.
We think that for Tesco's and Sainsbury's, on average, home delivery is profitable for them. It's not as profitable as someone shopping in a store, but it works. It's kind of really hard to see how it works for Ricardo at £13 a delivery.
Yeah. No, that's
So, the analogy, the example I always give is if my wife's parents are down in Somerset, so we spend quite a lot of time driving down the A303, and you just never see, a Tesco's or a Sainsbury's home delivery van driving a long way on the A303, whereas you frequently could be following an Ocado van for 45 minutes down there. That 45 minutes is like nearly 20 quid, right? Cost to them.
Yeah. No, it does really sort of question that sort of model, really. But anyway, so question here again on online. It's obviously benefited your Omni store model.
Yeah.
And that could go both ways. So if it decreases, then the store's still there. I suppose this is the wider sort of property market, but has this reduced the need for distribution warehouses, and I suppose for the grocery retailers as well?
Yeah, I think the grocery retailers have a kind of a backbone distribution structure, and then that takes them to the stores. So they don't get deliveries direct from manufacturers to stores for the most part. So it doesn't really reduce the need for distribution warehouses. I think all it really questions is whether that sort of central distribution model is really viable for grocery. And I think it is around places like London and Paris, right, where you've got the population density to justify it. But as soon as you get away from that, it's very hard to see how centralized distribution could ever work in grocery.
Yeah. Question here on your migration to the premium list of the stock exchange. Have you seen that increase liquidity, and what other benefits have you had from that, and shareholders have?
Yeah, I think it definitely increased liquidity because it meant that we were then eligible. So one of the strange things about the specialist fund segment is that you can't be in the FTSE indices. So we were, I can't remember how big we were when we went in, but we most companies that get into the FTSE 250, they do it, they get in right at the bottom, whereas actually we came in quite a long way up the FTSE 250 because we'd grown on the specialist fund segment and then changed over. So yes, definitely increased liquidity in the stock. I think for our size, actually, we've got relatively high liquidity. And we've got very strong, supportive brokers out there who actively trade it.
Yeah. Cool. Question here on Supermarket Income REIT's performance comparative to, because obviously you're the only guys really doing this in the list world. There's not many comparables, direct comparisons. Obviously, you're lumped with retail, but it's obviously completely different.
Yeah.
How have you compared to the other sort of broader commercial property sectors in this period of sort of rising interest rates and stuff?
It's a good question. I think we've kind of I think we kind of held up really well at the beginning, and then so it kind of like all these things when you do comparisons, it kind of depends which period you look at it over. But I think we held up well to start off with, and then kind of took more of a hit later on in the cycle of the interest rates. So I'm looking at a chart now to kind of remind myself. So Yeah, and then I mean, I think recently everything seems to have been performing kind of in line with one another. So if you look at us versus something like an LXI or as a kind of a peer in sort of long income space, I think
Mm.
we're tracking pretty much right on top of them, um,
Okay.
which is kind of interesting because we've got a higher dividend yield, arguably stronger tenants on average.
Mm.
And I would kind of argue there's you would think that we would outperform them, but
Yeah. So with this sort of structure of your leases,
hmm.
they're obviously long term. Are they? Do you get sort of annual uplifts? Are they linked to
Yeah.
CPI? Or is it every 5 years? What can you talk us through sort of the lease structure?
Yeah, so yeah, so just over 50% of them are annual uplifts, and then the rest are 5 yearly uplifts.
Right.
Um, and then in terms of inflation linkage, I think we're like 80%. Get the right number for you there. Um, we're about 80% linked to inflation. And so on the annuals, you'll get 78% linked. Yeah. So on the annual ones, you'll get usually RPI, but sometimes CPI, and it's on average that's capped at 4%. And
Mm.
then on the 5 yearly ones, you basically every 5 years you get the compounded inflation over the 5 years coming through.
Yeah. So on the open market side, did you say that's about 50% open market as well?
No, only about 20% open market actually.
Ah, okay.
Yeah,
Or the others on sort of
they're
fixed.
all on pretty much 78% on index linked leases. So out of the 78%, it's like a bit over 50% are annual and a bit under 50% are 5 yearly.
Right, got it. And then what have the open market rent uplifts been like over the last couple of years?
Yeah, so I mean, there haven't really been very many uplifts on open market rents. I'm not sure, we haven't actually gone through a review. We've got so few of them, but we haven't actually been through a review on open market rents. So we think there's some really interesting upside in those because there's been so much growth in grocery. And if you look at the kind of the market standard is you get about 4% of turnover for your rent.
Hmm.
So we think there's quite a lot of upside in our open market leases, but we just don't have very many of them.
Yeah, yeah. We've got a couple of questions coming about skin in the game. As management, how much does management and the directors, how much of those do they own in the company?
Yeah. Let me find the latest. I know what I've got. I'll just try and quote the aggregate. I think between Atrato and the directors, I think we've got around 5 million invested in the business.
Okay.
And we always hold. We've committed to hold 25% of the annual management fee in super shares.
Hmm.
I've we've all kind of added over the last period because we just really like the value in the shares at the moment.
Yeah. No, completely agree. Cool. Okay. I think we'll leave it there. I think we've sort of covered a lot of ground there. It's been really interesting to hear about the market and about the fund. Obviously, now's the time with interest rates seemingly peaked. I mean, don't touch wood. That now with the discounts we're seeing in the real estate sector, and obviously you guys and the strength of your tenants, I think it's really interesting time.
Yeah, I think we agree with that. I'm obviously not allowed to make any investment recommendations, but
No. Cool. Okay. Well, yeah. Thank you for your time. Been
thanks,
really
Richard.
interesting. We'll
Really
maybe
appreciate
try
it.
and get you on in the future. See how it's all going.
Great, thank you.
Cool. Thank you. Right. So that just leaves me to go through the legal stuff. You can read that in your own time on the playback. And over the next couple of weeks, we've got well, we're only doing 2 more weeks of this year. So we've got Murray Income next week with Andrew McHattie rounding up moves in November. Then we've got ABI Japan coming up on the 8th. Then we pause for a couple of weeks and then over Christmas, and then we're back in the new year with James and Andrew rounding up 2023. We've got a slot available and in 12th of January. So if there's anyone that you guys really want to hear about, do let us know, and we'll try and get them on. And then, as you see there, we've got a couple more for the rest of January. So yeah, again, thanks a lot for viewing today, and thanks a lot for Ben and Andrew as well. And we'll see you all again next week.